Okay, good morning, guys. I hope everyone's well. Looking forward to another day. The remarkable themes in these things called financial markets continue. Another extraordinary day. Perhaps oil again, sort of grabbing the headlines. But before we get into that, I mean, just looking through. Doing my usual sort of reading on the commute in. Some quite weird headlines. Weirdest headline of 2016 so far. Rupert Murdoch is marrying Jerry Hall. Okay, that's weird headline number one. Best headline of 2016. David Bowie occupies 7 spots on the top 10 albums on iTunes. Wow. He occupies the top 5. He's then also 8th and 10th. So 7 of Bowie's albums in the top 10. Adele, who was top, is now 6th. Scariest kind of headline, well, scariest headline has to come from the Telegraph with RBS cries, sell everything as deflationary crisis nears. This is getting a bit serious, this, in terms of the scaremongering and this is what RBS is saying now. They've advised clients to brace for a cataclysmic year and a global deflationary crisis, warning that major stock markets could fall by a fifth and oil may plummet to $16. Well, stock markets fall by a fifth. That's not that dramatic. I mean, that's 20%, obviously. So, look at my S&P chart. Oh, it depends if they mean falling by a fifth from where we are now. Well, let's go. I can't do it on a 1-hour chart. Let's do it on a weekly chart. What does that mean for the S&P? Let me just show you as we measure this in percentage terms. Hang on a sec. Get my percentage line out. So look, if they mean off the top, that's the May high, the all-time high, then 20% would put us, let's see, just above 1,700. Okay, we'd fall to 1,700 to make 20% off the 2015 high. However, if we're to fall 20%, if they mean from where we're trading right now, I mean, obviously, we've already had some decent downside here, especially last week. Obviously, worst start to the year ever. But if we were to fall 20% from where we are now, well, then that would take us down. Let's see here. That would get us down to 15. Let's see, about 1530. Let's say. I mean, that would be meaningful. A drop to 1,528. I mean, let's get this on a monthly chart. Get that in perspective. If we to fall to 1,528, then let me get a line on the chart here. That's back. I guess that's only back to February 2013 levels. It's not like, when you put it like that, it's not that dramatic. I guess the key level for the S&P, if RBS are anywhere near right, and they may not be, then the pre-credit crunch highs at 1586 here on the futures. But, scaremongering, when they're advising clients brace for a cataclysmic year. Also, news about, just on the hedge fund space, you're just getting slowly but surely. I mean, the last couple of years have been really bad for hedge funds. But Blue Crest Capital Management, they've announced this year they're returning $8 billion to investors. Nevsky Capital, I've just added to the mix here. They're returning $1.5 billion to investors. That's it. Shutting the doors, done. We're finished. And in a letter to explain it, they said they suggest a lack of transparency and liquidity are making it very difficult to predict the future in a manner that allows for adequate risk-adjusted returns. Transparency problems abound in emerging markets with China at the forefront. They also argue that an increasing number of important emerging market countries are conducting nationalistic policies over what had been a more transparent Washington consensus policy bias in the decade or so before the great financial crisis. So look, this is the scaremongering, RBS, these hedge funds shutting their doors, you know, big scale movements across sort of global markets, equities, worst starts of the year ever, commodities continuing the plunge off the back of China risk, oil down at 12, 13-year lows as we kind of sneak towards $30. It's not an environment for the faint-hearted, but I would say that the scale of the negative sentiment now is fairly extreme, to say the least, especially in the energy markets. And now you've got Morgan Stanley saying 20 to $25. You've got RBS saying $16. You've got Goldman Sachs saying $20. All these lot are saying that oil's going south. Morgan Stanley, for different reasons, they're saying the Chinese currency devaluation is the main thing to be worried about, that's going to drive oil and commodities further lower. I mean, this has been the story of 2016, of course. China devaluing their currency and it triggering volatility in markets. It's a concern because, you know, it perhaps flags up the fact that China's economy is weaker than we thought. Otherwise, why is the government carrying on with this devaluation policy? That's number one. If that is the case, China is weaker than we thought, then on the demand side, commodities have got a problem. I mean, we're already massively oversupplied, and then when you add a chronic weak demand environment to an oversupplied environment, well, that's like a double whammy. And so, yeah, sure, prices can go lower. Goldman's are pointing more towards something else. They're saying it's a storage issue. They're saying that storage facilities are filling up. And they're saying that the only way out of this is either to pump less oil, which doesn't at the moment seem likely, although, having said that, we have seen a couple of OPEC nations muttering, with Nigeria saying that two OPEC members have asked for an early meeting. That's the Nigeria oil minister who's heading up OPEC at the moment. So he said two OPEC members have asked for an early meeting. Wouldn't be surprised if it was Nigeria asking themselves for a meeting. And it wouldn't surprise me if it was Venezuela, who are the other ones. They're the kind of two that are most feeling the pain here. But as I keep stressing, unless Saudi want to cut production, no one's cutting production. This is a fact. So unless we get news from Saudi, you kind of write off any chance of an OPEC meeting, I would say. What I was saying the other week, if Saudi arrange a meeting with Russia, I would say that would be the key headline you're looking for, that might begin a path that sees a coordinated production cut. But at the moment, there's no sign of that. A Saudi-Russia meeting would be an interesting development. But back to Goldman's, they think because of the storage problem, you're going to have to see oil starting to be stored at sea on oil tankers. Now, that's very expensive. So price needs to be low enough to make seaborne storage economically viable in the eyes of Goldman's, which means you need oil at $20. So this is the kind of climate we're in. I mean, I think we are reaching, extreme. Will, you've been through Will's behavioral finance lectures. Is this the point where we're seeing now a crowded, an overcrowded, negative sentiment market? Have we got to irrational status or not? I mean, it's very hard to measure irrationality. And then also you've got to recognize that irrationality can last for a long time. So the dangerous game, picking bottoms on markets that have slid so sharply. But it does feel like the general mood in markets is now over extreme. So anyway, let's move forward. What have we got on the slate for today? Let me just bring up a screenshot of calendar here. That's the thing. At this point, this week, news flow is low. Well, it's low on the ground, that's for sure. And so that's new macro news flow, that is. I should say, here's the calendar, but I should say China overnight, again, have been, equities in China have actually bounced. Well, I say bounced, maybe better to say they've stopped going down. We've got the Shanghai Comp up 0.48%. The People's Bank of China active in the currency markets, not by fixing their currency rate lower. We've got a third consecutive session where the People's Bank of China have fixed the onshore currency rate unchanged. What they've been doing is buying the offshore rate. We've seen quite a notable divergence and widening spread open up between the onshore yuan rate and the offshore yuan rate. Now, People's Bank of China have been closing this spread by buying offshore. This has mopped up a huge amount of liquidity in the Hong Kong money markets, which has actually led to a massive spike in the Hong Kong interbank market rate, which does have quite significant potential negative scenarios with regards to the normal day-to-day operating of the Hong Kong banking system. When you've got overnight lending up at unaffordable and not unjustifiable levels, then it can just create problems for the functioning of the banking system. And we all know what happens when that kind of occurs. That's what you call a credit crunch. So look, I'm not calling a credit crunch in Hong Kong here. I'm just saying that China's aggressive purchasing of offshore currency has led to a spike in the interbank offer rate. It's just something to monitor. I think that with China, people are freaking out, and that is because there's such a lack of transparency. We don't know what they're going to do. I don't know if they know what they're going to do. That who knows? But I would say that I think lack of transparency breeds uncertainty and fear, and you assume the worst. I think it's irrational in many ways because China's stewardship of their economy over the last decade has been almost perfect. They have begun to make some errors this year, and that's only come as a result of them trying to control the untamable beast that is a stock market. But generally, they've got a pretty good record. So I think markets don't give China quite enough credit in terms of their ability to manage their economy. It's the uncertainty, the not knowing, that breeds fear. And I think that's what we've got at the moment. I think people are freaking out and are expecting, really they're pricing in a big, massive, sharp devaluation of the yuan. What's happened so far is actually a very relatively small. The Chinese yuan is about 2.6% weaker against the dollar than it was last summer. So you've had a 2.6% weakening. Okay, if you look at the yen, that's 30% weaker since Abe tipped up. The yen's 30% weaker. The yuan is like 2.5%. These aren't large devaluations, but it's the uncertainty that there might be a large devaluation that I think is spooking markets. So I think this China risk has now escalated to not rational levels. But as I said, irrationality can last a while. So you've got to be careful, but it certainly makes for a lot of volatility intraday and momentum and large-scale movement. And if you're managing your risk properly, there's certainly some pretty substantial upside opportunities. Let's look at the calendar for today. Not much industrial and manufacturing data out of the UK. This is at 9:30. Into the US, again, not much until we get to 3 when we get more labor market data. Of course, we've had the key, and what a report it was on Friday last week on the job creation side. It's just a bit disappointing on the wage growth side. But we've got JOLTS job openings figures here at 3 o'clock, and we've got the IBD tip economic optimism number. In the grand scheme of things, with a market environment that's driven so and dominated by sentiment, these kind of data points are not relevant, it must be said. We've got a load of speakers, many of them from the ECB, including Weidman, who's chief hawk. We also got Carney speaking today as well. Pryatt also is busy. Kaplan from the Fed overnight, but we've got Lacquer tonight. Okay, so here's the speakers. The other thing to mention is Alcoa. kicked off earnings season last night. So we have US Q4 2015 earnings season up and running. It's a bit slow this week when it gets started. We've got a few of the big banks reporting at the end of the week. But really, it'll be next week and the week after when really the frequency and the magnitude of these earnings reports ramps up and we start to hear about corporate performance last quarter. It's an important one. Quarterly earnings have been deteriorating throughout 2015 and we're expecting another weak quarter. So whilst the S&P is on the back foot as a result of global negative sentiment, if you add in a bad earnings season, then this could be the catalyst. If I just go back to my weekly chart, it could certainly help to continue and sustain the downside bias here. The key level on the downside next up in terms of the target, I would say, is 1860, which is the end of September low. You've then got the August low at 1831. Before you think about the October low at 1813. All right, these are some of the key supports on the way down if earnings season does add to the downside bias. But Alcoa are interesting because, of course, they're a big aluminium producer. They're a commodity producer. And actually, they were, even though their share price slipped a little bit after market, they were a little bit, well, I would say surprisingly upbeat about demand. Now, some of this is because of the fact that, let's say, automotive manufacturers are beginning to prefer the use of aluminium instead of, well, not beginning to, continuing to prefer the use of aluminium rather than steel, for example. And so, you know, internally within the commodity markets, you're seeing aluminium win a bit of market share over its brother, which is iron ore. That's one thing to think about. But the Alcoa chief reckons that aluminium demand is going to increase by 6% this year. So, you know, whilst the world is freaking out about collapsing commodity demand, here you've got the head of one of the biggest commodity producers in the world saying, actually, demand's going to go up 6%. So I think that's quite interesting and needs to be factored in amongst what is otherwise, you know, a market environment that's just kind of freaking out a bit. Just in terms of going through the session here, we've had China again not sell off. We had a bounce into the close on the US last night, although that just keeps us in this range. Look at my 1 hour chart on the S&P. This is quite important. Quite a nice trend line here, just really shaping this year. And, you know, we've been flat now. Well, after yesterday, after the sell-off at the beginning of yesterday's session, we've then been sideways now for 30 hours or so, or more. And we're at pivot resistance so far, but keep an eye on the trend line. So any movement towards sort of 1920, which is the overnight high, might be interesting in terms of getting some upside going on these heavily damaged equity markets. Oil needs thinking about, obviously, more downside overnight, sliding below 31 bucks, $30 next up. This is the key price point, I think. I think $30 is a very psychological destination to arrive at, and we're pretty much there. Today's low, $30.42. So keep an eye out for 30 bucks today. The Bund has broken below the double bottom from the 7th and the 8th of January at 159, and so we're down below the 159 handle. So at the moment, there's just a bit of stabilization in some of these equity markets, despite the fact oil sold off again. Bunds are indicating as well that perhaps this risk-off sort of pattern has done its course. It's quite interesting here that the Bund is trading levels that we were trading on the 5th of January. But if you look at equities, on the 5th of January, the DAX was, you know, a good 300, if not 400 points higher than where we are now. The S&P on the 5th of January was trading at 2,000, you know, almost 100 points higher. So you're actually seeing a bit of a disconnect here with certainly the Bund failing to really get anything going on the upside, despite the fact we've had chronic risk off. So bear that in mind when you're thinking about bullish intentions on the German 10-year. All right, I'm going to leave it there for now. Data out of the UK at 9:30. Enjoy the session.